I think the most frequently asked question that I get from investors or potential investors is, well, the fund has done very well in their opinion, and as a result, doesn't it mean all the companies you invest in are very expensive and we shouldn't really be investing any more money in these companies? And discuss, they say. And there are a lot of things to say about that. I mean, probably the most important thing up front is they might be right. I haven't got some great insight into what's going to happen in the world next. I'm absolutely certain we own a portfolio of very, very good companies. But I can't tell you what will happen next in any of their share prices. And, you know, as a great man once said, if you think you can, give me a call. It'll be very useful, but I'm not alluding to that. We track a number of things to try and see whether or not we think there's still value there, because we like to believe that in the event that we didn't think that there was any value from continuing to invest in these companies, we'd stop, basically, because we think it would be the only reasonable thing to do. One of the key measures we look at is the free cash flow yield of these companies, which sounds a little technical for the non-investment professional, but isn't really. It's the amount of cash that the companies generate after all their expenditures each year, divided by their market value. Because we take the view that we own those cash flows. They may not pay them all back to us as dividends. They may reinvest some of them in the business to grow the business. Most businesses I've ever encountered need additional capital to grow, and we want our companies to grow. Or they may use it to buy companies. We hope that's not their most frequent use of cash, because typically that goes wrong, but there is some of that as well. But that free cash flow yield, whether it's used to acquire things, whether it's used to invest further in the company, or whether we receive it back in dividends, that's ours. That's what we own. And when I'm investing your money, I compare that free cash flow yield with a number of things. But my sort of bottom line yardstick on it is, and I choose my words carefully, is I look at the free cash flow yield on our companies and I compare it with what I think the long bond yield should be in any currency. And the key words in that sentence are should be, not what it is, because if you look at the long bond yield, you'll find it's, depending on which developed market you choose, somewhere between 2 and 3%. But it's of course at that level because across the developed world, governments have spent their time for the last couple of years buying their own bonds by so-called quantitative easing or printing money. And funnily enough, when they buy their own bonds, they don't pay a very high price in terms of coupon, because clearly one of the things they want to do is to drive down their cost of borrowing by this activity, one of the things that they want to do with it. And so they're basically arguing with themselves about what the yield should be on those bonds. And as a great man once said, an argument that a man has with himself rarely descends into a barroom brawl. And so when the government's thinking of buying its own bonds, it doesn't sort of say, well, I think the right price for these bonds is a 6% yield, which is, it pays this very low rate. So what should it be? I work on the following basis. I work on the basis that if I were a rational outside investor buying these bonds, and by the way, just as a footnote, governments will eventually have to get back to selling their bonds to those people because they are running deficits, they're spending more than their income. What should that yield be if I were a rational outside investor? My guess is I'd want a yield of at least 1% over the expected rate of inflation. I'd want the protection of a 1% real yield from my bonds. And at the moment, depending upon what inflation figure you want to believe, but if you take the official ones, that would probably get you to about a 4 to 4.5% required yield on the bonds, I would say. So that's my kind of bottom line. I will only buy companies, therefore, that have a free cash flow yield, as I defined it for our companies, which is about 5% or more. And the reason for that is if I buy those companies with that yield that's higher than those bonds, I can be sure of one thing. Over the long term, the free cash flow yield of our companies will rise. They will generate more free cash flow as time goes on from that starting price that I own them at. I can be equally sure that the coupon on the bonds won't go up. That's what happens with bonds. They have a fixed coupon. And so we have almost certainly created real fundamental value if we can buy our companies on a free cash flow yield that is higher than bonds should be yielding at this time. Okay. I had a look this morning, and 23 of the companies that we either own or would be willing to own have a yield of more than 5%. It's not as many as I would like. I wish the whole lot had a yield of more than 5%, frankly. Then we could buy absolutely everything that we would like to buy amongst those companies. But we try and maintain the discipline of not overpaying. We try and do that, apart from the small fact that we're managing your money as well as our own money. We're not trying to own these shares to on-sell them to somebody else later on at a higher price. That's not what we're trying to do here. So we can't overpay, hoping that there's somebody even more foolish than us who'll overpay even more. We're trying to buy them and just keep them and garner those cash flows over time. And so with that in mind, we really won't overpay, or at least knowingly overpay, and I'm pleased to say that we still have a significant portion of the investable universe that we would be prepared to invest in, and indeed are investing in. So just at the moment, I think the answer is that we still think that there is value available in this. And frankly, it may go further, but one of the supplementaries I often get asked by people is, well, look, these companies are very good companies. I think they are. And you know, I think they are provably very good companies. We're not talking about some kind of judgmental matter. They produce very high returns on capital employed in cash. They do it consistently. They do it year in, year out, even at the bottom of economic cycles. They can reinvest some of those wonderful returns to grow their value over time, etc., etc. They've been established for a very long time, sometimes for over a century, and so on. And most of them you've heard of. You may even have heard of all the companies that we'll invest in. I mean, there's only about 70, so I mean, it's not exactly an enormous universe. So how is it that it's possible to buy these companies that are such good companies, but buy them a bit cheaply? How does that work? And I think there are many explanations for that, most of which have got to do with concepts of economics or behavioural finance, which I'll delve into very briefly, because I think it's not that sort of meeting where we're going to sit here and do a hypothesis on economics. But one of them is, I think on average, that the way that the market values companies is by a concept called mean reversion. Strange enough, there was an article about it on the back of the Financial Times fund management supplement this morning by a man called Edward Chancellor from a fund management company called GMO. And mean reversion means this: if a company's got very high margins and very high returns on capital, it will attract competition. People will enter the industry, competitors will expand, the company itself will employ more capital as well. And gradually those returns will be driven down towards the average for the market. And if a company's got very poor returns on capital and very poor margins, capital will exit that strategy. Basically, companies will exit because they can't make an adequate return. Companies will go bust. Nobody will invest in new capital. And gradually, the returns within that company and that industry will start to gravitate up towards the mean. And I think it's a very, very good theory. And I think as a way of valuing companies on average, I salute it. I think it's the sort of thing that people should apply. I think that the reason that this strategy or one of the reasons why this strategy may be viable, is viable and may continue to be viable, is I think there are a small group of companies in the world that don't mean revert, that have superior margins and superior returns that don't get competed away. And that's because they have huge intangible advantages. They have brand names, patents, intellectual property, distribution networks, installed bases of equipment to which they have a tame market for selling spares and service, or all of the above. And as a result, they're able to fend off competition so that the capital can't enter their markets readily to mean revert. And those are the companies that we seek to own. So I think there's an economic reason for us being able to buy these companies somewhat cheaply. I think there's also a behavioural reason, and that is, I think, as investors, as human beings, we're attracted to excitement, basically. If you look at investors, they seem to believe, and there's quite a lot of economic theory to support this, that in order to make a superior return, they have to take a higher risk. We're taught that. There's economic theory behind it, the efficient markets hypothesis. There's plenty of folklore behind it. There's no such thing as a free lunch. You know, if you want to make more money, you have to take higher risk. Unfortunately, for about the last 50 years, all the statistics tell you the opposite. You make most money from the most stable and least volatile shares. But still people persist in buying the small companies and the very volatile shares, thinking that by assuming that risk, they're going to make more money. There's no sign of that whatsoever. But I think we are innately attracted to it. I think the best way of describing why we do it is the so-called lottery ticket effect. You know, if you buy a lottery ticket, you are definitely not basically someone who's done it on the application of statistics, because you're overpaying for the odds of the very large win. But it's the very large win that attracts you. And that's why I think we are attracted towards these very apparently high return risky companies. And that's what gives us our opportunity, I think, to buy our very good, relatively predictable companies at a relatively cheap price. So, yeah, I often get asked about valuation. Probably the most amusing questions I get about valuation are from a couple of people that I encounter who we talked to at the outset of Fundsmith, or even before we set it up, who said a couple of things which always amuse me. One of them being, Well, I mean, your timing's really poor at the moment. I mean, the economic outlook is bleak. You yourself are very bearish about it, etc., etc. You know, have a look at it another time. Some of the same people say to me, well, it's only succeeded because of the good timing. I mean, if you hadn't started it then, I sometimes wonder if they ever sort of remember the things they previously said to you. And the other one I particularly like is the people who said, look, I really like the strategy and what you're doing, but I do think that this is a bad time at the moment, and I think, you know, when there's been a significant decline in the market, I'll buy some. I often think we're up about 50% today from inception. If we'd started at 100 and we're now trading at 50, and I said to them, good news, we're down 50%, want to put some money? What do you think the outcome would be? So it's wonderful. I don't think sometimes people's self-knowledge in terms of their behavioural characteristics in investing is very good. Hopefully ours is very slightly better. There we are.